Welcome to this explainer. I am so thrilled to have you here today because, look, we're going to unpack something that will completely transform how you look at your charts. If you've ever sat there feeling like the market just has a mind of its own, you're absolutely in the right place. Today, we're going to bridge the gap between those little lines on your screen and the real-world macroeconomic events that actually make the candles move. So let's start with a scenario that I know we are all way too familiar with. Why do perfect technical setups suddenly fail? I mean, you've done your top-down analysis, you've drawn flawless trend lines, pinpointed your exact entry zones, the risk to reward is looking beautiful, you enter the trade, and then, literally out of nowhere, a massive sudden price spike completely obliterates your position and stops you out. It's incredibly frustrating, right? You're sitting there staring at your setup wondering if the whole thing is just rigged. But I promise you, it is not random. But before we reveal exactly what caused that spike, we really need to look at how we react to it. Take a look at this incredibly heavy-hitting quote from Stick Trader. The market doesn't destroy you with a losing trade. It destroys you the moment you break your discipline. And honestly, that is a foundational truth right there. Getting stopped out by a sudden market shock, that's one thing. But blindly trusting your indicators and losing emotional control during all that market chaos, that is a surefire way to blow an entire account. If you want to maintain your discipline, you have to actually understand the forces that are causing the chaos in the first place. Section 1. The Invisible Engine. Fundamental Analysis. Okay, I want you to think of the Forex market like a giant iceberg. Technical analysis, so your charts, candlestick patterns, support and resistance lines, all of that is just the visible tip resting above the water. It just shows you what price is doing right now. But fundamental analysis, that represents the massive, incredibly powerful underwater currents that are actually moving the entire iceberg. Basically, it's the study of economic, social, and political forces that drive currency prices by affecting supply and demand. Price doesn't just move randomly in a vacuum, right? It's driven by actual, real-world economic forces. The big institutional money, the banks and hedge funds that actually move the needle, they're trading based on these exact fundamentals. So the crucial point here really comes down to a super simple binary cause and effect rule. On one hand, a strong economy equals a stronger currency. If a country boasts great employment, high consumer spending, and strong growth, well, foreign investors are going to want to park their money there, which drives up demand and naturally the price of that currency. But on the flip side, weak data means the currency drops. If an economy is struggling, investors pull their capital out and the currency devalues. It is quite literally the ultimate game of global supply and demand. Section 2. Navigating high-impact news. Now, there is a lot of economic data floating around out there, but you really only need to hyper-focus on what I call the big three. Number one is central bank interest rates, especially the U.S. Federal Reserve. When the Fed changes rates or even just hints at quantitative easing, which is essentially printing money, it instantly shifts global market dynamics because capital always flows to where the yield is highest. Number two is CPI, which measures inflation. Sky-high inflation usually forces a central bank to raise those rates. And number three is NFP, or non-farm payrolls. That's the big U.S. employment report dropped on the first Friday of every month. I mean, if the U.S. suddenly adds way more jobs than expected, boom, the U.S. dollar will violently spike in literal seconds. Section 3. Risk-on versus risk-off sentiment. You can really think of the global market as this giant pendulum just constantly swinging between fear and greed. During risk-on sentiment, the market is wildly optimistic. Investors are feeling greedy, right? So they pull their money out of safe, boring assets and dump it into higher-yielding, riskier assets like stocks or maybe the Australian dollar. But then you have risk-off. This is when fear completely takes over, maybe due to a sudden geopolitical conflict or a totally disastrous economic report. Investors panic, dump their risky assets, and flood their capital into safe havens like gold, the US dollar, or the Japanese yen. And the crazy thing? These massive sentiment shifts can happen in the blink of an eye, completely overriding even your absolute best technical setups. Section 4. The ultimate defense, your Forex calendar. And this brilliantly illustrates why integrating a Forex calendar into your routine is absolutely non-negotiable. It's just 3 simple steps you need to do every single morning before you even glance at a chart. Step 1, check the release times for the day. Step 2, identify the high-impact events. These are usually marked with big red folders on most calendar tools. You gotta ask yourself, is there a CPI report today? Is the Fed speaking? And step 3, adjust your risk or simply step aside. Look, if you have a beautiful setup forming exactly 5 minutes before the NFP data drops, you don't take the trade. You are essentially preparing your battlefield before the fighting even starts. Because preparation leads directly to survival, which brings us to this incredible analogy from TradeZiety. Your stop loss is a seatbelt. You don't put it on because you expect to crash. You put it on because if you do, you survive to drive again. This right here is the absolute core of risk management. When we talk about having an awareness of fundamentals, we're really talking about anticipating the crashes. Because honestly, even with your calendar open, surprise news can and will hit. Having that stop loss firmly in place ensures that a sudden, violent shift to a risk-off sentiment doesn't just blow your entire account. It means you survive to trade another day. Section 5. The discipline to wait. If you take away anything from this explainer, let it be this stark, golden rule. When in doubt, do not trade during the news. As a technical trader, your entire edge relies on market structure and predictable liquidity. Well, high-impact news temporarily destroys that structure. Spreads widen aggressively, which means your cost to even enter a trade suddenly spikes, and slippage happens, meaning your orders get filled at terrible prices while the price just whipsaws in both directions in a matter of seconds. Avoiding these unnecessary high-risk losses is just as important, honestly, maybe even more important than finding winning setups. Sometimes sitting firmly on your hands is literally your most profitable strategy. Which brings us full circle, right back to this incredibly powerful lesson from Stick Trader. Long-term success in the market doesn't belong to the smartest person, but to the most disciplined one. Look, you can have every complex smart money concept memorized perfectly, you can draw the most pristine Fibonacci retracements known to man, but if you lack the discipline to simply check your Forex calendar, respect those fundamental forces, and sit out during high-impact news, you are eventually going to lose your capital. The edge isn't just in the strategy, it's in the trader who is executing it. So as we wrap up this explainer, I want to leave you with one final provocative thought. Really ask yourself, are you willing to skip a trade today to ensure you are still in the game tomorrow? Let that sink in for a second. True trading mastery isn't about wildly trying to catch every single move. It's about aggressively protecting your capital by understanding that massive fundamental engine driving the market and having the sheer discipline to wait for the storm to pass. Thank you so much for joining me to unpack this. Go check your calendars, manage your risk, and as always, keep learning.